All right, everyone. Thanks so much for joining us in this video. I'm Daniel Rondberg. I have an extremely special guest to me. I'm so excited to be doing this. I've been wanting to do this for like 3 years. I have Harlan Accola with me, who I heard speak about 3 years ago at a conference that I was reluctant to attend, but I ended up forking over some money and attending this event. And I'm so grateful I did, because the knowledge I got from that, just from hearing this man speak, has changed my life and has changed the lives of, at this point, almost 100 of my clients. I've shared this information with so many people. And so I'm grateful, Harlan, to you for taking some time for me. Thanks for joining me today. I really appreciate it.
I appreciate the opportunity. We want to change retirement for the better for a lot of people, and we can do it by working together.
That's incredible. Yeah. And my mission is to help people realize their purpose in retirement. And I really feel like the information that you're traveling the country trying to raise awareness for aligns with that so perfectly, because of what it does in people's lives in such a powerful way. So I want to start off by asking you, because you are an expert in mortgages and really, in my mind, the foremost authority on this subject in the country, what is the right way for people to be using their equity in retirement?
Well, people need to look at a house that they're buying as truly an investment. And I learned about this when I was in my 40s. I'm now in my 60s. But when I was in my 40s, I realized, hey, I'm putting all of this money into my house. How can I ever use it? Because most people just want to pay off their house, pay off their house, pay off their house. And then the reward is you don't have to make a payment. But most people have hundreds of thousands of dollars worth of wealth in their house. And so as an example, everybody has 3 buckets of wealth if they own a house. Bucket 1 is their bucket. That's their ability to make money. Bucket 2 is your bucket that you and your dad work together with your clients to grow their life insurance, their annuities, their 401k, stocks, bonds, whatever it is, money that they don't need today, but they're nest egg for the future. That's the bucket 2 in the middle. Bucket 3 is what we work in every day. And people put a tremendous amount of money. Some people have 500,000, a million, 300,000, 800,000, 2 million, whatever, stuck in bucket 3. And the goal is to have it all paid off so that you don't have to make a payment when you get to be in retirement, which makes sense. It's not a good idea to have a mortgage payment in retirement, but it's a good idea to have a mortgage in retirement, because if you keep the mortgage going and you do a reverse mortgage instead of a forward mortgage when you're younger, you can start taking back all of the equity that you put into the house. So just like your clients come to you and say, hey, I put a bunch of money into this life insurance policy, I'd like to take some out. I put money into my IRA, my 401k at work, I'd like to take it out. That's normal and expected. But our culture does not teach us that it's okay to use money from bucket 3, just like we use Social Security from bucket 1, the money from an IRA or a life insurance policy or an annuity in bucket 2, we can also take money out of bucket 3. If we do, and it's really that simple, if we do that, we will have a longer use of money, will leave a larger legacy, and in most cases pay a whole lot less in income taxes. It's really as simple as 1, 2, 3, but a lot of people never looked at bucket 3 and they just try to do everything in bucket 1 and bucket 2. So they're not properly using their home equity. It's just kind of something to talk about, and it's off there and it's sitting right there in the living room, but they don't get to use it.
Wow. That's absolutely incredible. I have a confession to make. I'm guilty early on in my career of being one of those financial professionals who specialize in retirement income, who clients would ask me about this strategy, and I immediately would dismiss it because I just didn't know the truth. Like I didn't really fully understand it like I do now. And I would always dismiss it and just say, oh, that's not a really good idea. I'd stay away from those, and not even knowing what I didn't know. And so I think what blew me away about the first time I ever heard you speak at your event, was I'm always looking for some type of edge in retirement income to improve my clients' lives. And I think that the only way to do that is to increase income or decrease, liabilities and monthly cash flow going out. And so that's what clicked for me. That was the light bulb moment when I saw you speak. I was like, oh my gosh, I've been spending all this time going through things with my clients to try to reduce liabilities. This is such a crucial strategy to boost cash flow and improve the quality of someone's life. It's like one of those things that once you see it, you can't unsee it.
Well, you're exactly right. And the problem is, I used to be in Taekwondo. And if you had to go through any of the procedures in Taekwondo with one hand or one arm, one leg, you wouldn't be able to do very well. And yet some people try to go through retirement with just the 2 buckets instead of going to the 3rd bucket. It's like tying one hand behind your back. Use everything that you have, because retirement is a little bit scary, because when you're 30 or 40 and young, like what in an age group like you, well, you got plenty of time to make money back that's lost. You only get one shot at retirement. There's no do-overs. And if things don't go well and you run out of money, people say money isn't everything, but it's reasonably close to oxygen. It's kind of important, and you need it. And realize we're going into true confessions. I told people, I was in the forward mortgage business 20 years ago. I told people to stay away from those things, they're bad, until I understood I was wrong. And then I really started looking at the money on how it flows throughout retirement and before retirement. Then it all made sense. And what's kind of funny is the lady came up to me at a seminar that I was speaking at, and she said, I'm an advisor, and there's a whole bunch of people that told me that you think that most people should get a reverse mortgage the day they turn 62 to reverse the money flow coming out. And so I just want you to know, I don't believe in that. And I said, well, ma'am, you don't have to believe in it. We're not teaching a religion. All you have to do is understand math. And we're talking about math. We're not talking about a belief system that you may have with anything else. And so she came to the seminar, and now she's going to do her own reverse mortgage and recommend it to her clients, because she realized that, oh, okay, this makes a lot of sense. As you said, once you see it, you can't unsee it. Because if you use bucket 3, it changes everything when you get to that bottom rectangle, the bottom wallet of your post-retirement income.
Yeah. I agree 100%. I think that's so well said that, and that's my next question that I want to ask you is, what is the stigma behind these? Like, why are people so like emotionally charged or so quick to dismiss this when they really don't understand it? Like, what is it about these reverse products that makes people so like gun shy about them?
Well, I wrote about that in the chapter in my book. And by the way, if anybody listening to this wants a copy of the book, I'm not in the business of selling books. I'm in the business of helping people in retirement, and I'm a mortgage guy. So we're in the business of doing mortgages, not selling books. And so if they want a copy, I can certainly get them one.
That's so nice. Thank you.
Here's the deal. The chapter in my books is drugs, sex, and reverse mortgages that covers this question. Drugs can be good or evil. They can kill you with an overdose, or they can save your life. Sex, of course, can be good or evil. Reverse mortgages are the same thing. So are annuities. So is life insurance. So is investments. So is mutual fund. Anything can be used incorrectly. You can use a car incorrectly. So this is not about whether or not reverse mortgages are good or bad. It's about how they are used. And there are two things that were done that gave us a really bad name and a bad reputation. The first one is that too many people that could not afford their taxes and insurance got a reverse mortgage. And when they didn't pay their taxes, their real estate taxes, they got foreclosed on and they lost their house. And it was all over the news that these people got foreclosed on because they had a reverse mortgage. They didn't get foreclosed on because of the reverse mortgage. They got foreclosed on because they couldn't afford to pay their income or their real estate taxes on the property. Wow. And then they ended up losing their house, but they would have lost it anyway. But our industry was blamed for it. They should have never had that house. They should have sold it and bought a smaller house, or moved in with their kids, or rented, or whatever, because they couldn't afford the taxes on that house. And we were just delaying the inevitable. And so that all changed. And now there's very specific filters and guidelines that you can't get a reverse mortgage if you can't afford the taxes and the insurance on the house, because then you can't keep it. So the second thing was even worse. And that was that usually older man, an older spouse, let's say they were 65 and they had a young wife that was 50, 55, they would take their wife off from title, and then they'd do the reverse mortgage, which was fine until they died. Yeah. And when they died, their wife got kicked out of the house. When you start kicking widows out of the house, that looks really bad. Front page news, USA Today, ABC News with Diane Sawyer. It was awful. It should have never happened, but it wasn't the fault of the reverse mortgage. It was the fault of stupid men that took their wives off from title and endangered them, because most men die before their wives. And so when you have an underage spouse, I happen to have an underage spouse, not under 18. She's under 62. She's 59. But she can come along with my reverse mortgage, and she can stay in the house for the rest of her life. We can enjoy all the money coming out of the house with no payments, and we can have a better retirement, more fun with the kids and the grandkids. And she's guaranteed to stay in the house if I die tomorrow, or if I die 20 years from now, or 30 years from now. That's the two important things. But once that was branded as something that kicked widows out of houses and foreclosed on people that could not afford to pay their taxes, that just kind of spread like wildfire, and it got a bad reputation. just like some people get a bad reputation because they did something wrong and now they're good people, but it doesn't matter because people still remember what they did in the old days. That's really what happened with reverse mortgages. And here's the other thing. Most of us baby boomers went to mortgage burning parties with our parents. Your age has never been to a mortgage burning party, but that was a big thing.
Yeah.
And so it was culture. It was expected that Depression era parents that saw their parents, or they lost a farm or they lost a house, it was, no, debt is dangerous. And it was. Back then was an entirely different situation. There were no reverse mortgages. There were no 30-year fixed mortgages. People would lose their house because they had to come up with the money every 2 years or every 5 years or whatever to refinance. That's not the case anymore, but our culture still says the safest thing to do is to pay off your mortgage. The safest thing to do is have a mortgage that does not require a payment, which happens to be a reverse mortgage. That's really the situation. You should go into retirement without a mortgage payment. But if you have a mortgage, you can access all of the money that you put in that bucket 3 throughout your working career and now have that to have a better life in retirement.
That's so incredible. That brings up two things that I think are so important that I talk about all the time. I always talk about having the right team behind you. So I think one of the biggest problems in the financial services business is like everybody focuses on their discipline and they kind of like ignore everything else. And it kind of leaves the client or the person who you're helping and serving responsible for communicating amongst all those professionals. I feel like, in that case where people were getting kicked out of their houses, maybe they didn't understand estate planning or titling and things that maybe an estate planning attorney would have advised differently. So I think that's why it's so crucial to have this team, and why I'm grateful that your company is who I consider to be that portion of our team when we need that level of expertise that we can communicate with to help serve clients. And the other thing too, that I've argued for a long time since I read your book, was I don't know how people can help serve clients with planning for retirement income without reading your book. I'm arguing that it's a really crucial prerequisite for anybody who's considering themselves somebody who's proficient in retirement income planning, because it's such an integral piece to the client's life that, how could you really do it with, it's like you said, it's like trying to do Taekwondo with a hand tied behind your back. It's almost, it doesn't make sense.
Yeah, that's, we only deal with financial advisors who are holistic planners like yourself. Mm-hmm. If somebody is only selling a specific product, or they only sell stocks and bonds, or they don't know anything about annuities and life insurance, we don't want to deal with them, not because we don't like them, but because they cannot really fully help their clients. Right. And so we don't want to get in trouble by working with them, because we know, we just had somebody today, Daniel, that was completely opposite of the way you and your dad run your operation. The only thing he knows how to do is, and he's pretty good at it, is to invest in stocks and a little bit in bonds. That's all he knows about. He doesn't know anything about annuities. I know more about annuities and life insurance than he does, and I'm not even licensed. It's scary. So he might be pretty good at figuring out when to buy and sell stocks, although he didn't tell his client to sell his stocks in December. But anyway, the bottom line is that when you're looking at a holistic plan, you need to look at the estate plan. You need to look at the long-term care issues. You need to look at what you want to leave behind for your kids. Those are the factors that people just are not realizing, that you can do all of these things right. But if you screw up your long-term care plan, well, then that screws up everything else. Right. And if you end up not being able to afford your house in the end, like we sometimes do loans that are the loan of last resort because people never employed their home equity early in the scenario. Well, if they don't look at it early, then there's going to be problems in the bucket 2 scenario in an earlier situation. So bottom line is that and I'm going to be really strong on this, but anybody that's listening to this that are not using an advisor like Daniel and his dad, or any specifically, of course, using Daniel, you need to come and do that and change your portfolio over, because it's dangerous when somebody is just doing one thing and not looking at the other aspects. You are going to have some problems in the future.
Wow. Well, thank you so much for that. I appreciate it tremendously. Yeah, I always tell my clients whenever they're asking me about if they should work with somebody or something in some capacity, I always ask them what books they read. And I really think that should be mandatory, like that some of those books that talk about retirement income planning, your book on reverse mortgages, I thought was so important. And I'd never read anything like that. And that's what really changed things for me. And like I said, I've been able to take that information and help serve other people with it. It's been Absolutely incredible. So I've had an amazing experience working with your company, and that's why I'm grateful we took some time to do this. So tell me a little bit about some of the things that they put in place to protect against those scenarios so that it's not like the days of old where people can't afford their income taxes and they end up losing out on a foreclosure. Like, what are a couple things they've done to improve that scenario to protect people?
Yeah, the good thing is this is insured by FHA, and so there are more regulations. There are more specific guidelines. It's not just something that we can decide to do things on our own, even though we're a good company and we follow solid principles of how we do things. The guidelines that are set in place are designed specifically to protect the borrower. So the two major issues is, first of all, we make sure before we do the loan that the people are in the right house and they can afford to stay in there. They can't afford the maintenance, if they can't afford the taxes, if they can't afford the HOA, well, then they need to move. This isn't sustainable. We just worked with somebody in New Jersey. Their property taxes are $26,000 a year on a $700,000 house. Well, you got to have a lot of money, even if your payment is zero, to do that. So that's the first thing. The second thing is protecting the underage spouse. My wife, even though she was not 62 when we did this, if I die tomorrow, or if I make it all the way to 90 years old or whatever, she can never be kicked out of the house if something happens to me first. That's pretty cool. There's a guarantee. She can leave if she wants after I would pass, but she doesn't have to. And that is something that is an absolute guarantee in writing, backed up by the federal government, not just Fairway. But probably the most important change is what we do, and that is working in conjunction with the financial advisor, because you can't do this really well by ourselves. Fairway doesn't have a wealth management division. We don't want to have, because we just want to have people that specialize in mortgages. So we partner with people like you. The problem is, if that is not done, then there can be all kinds of things that go wrong, because if it's not run through the software and you don't take a look at, is this income sustainable? Well, then it just might not work at all. So when those changes are in place, those are the things that make a dramatic difference in the outcome, because it's being properly used. Because it's a complex financial product, just like your products are, from annuities and life insurance and so on. And if you don't have someone guiding you through that, the chance of making a mistake is really high, and it's just not a good idea. And so those are the things that make a dramatic difference in the safety of the product. And the one thing that I want everybody to be very aware of, it is impossible to leave a debt behind for your kids. If it's upside down at the end and I die in the year like 2009, and I owe $400,000 on my house and it's only worth $300,000, that is forgiven with no tax consequences. And that is a very significant issue, because we don't know when we're going to die, and we don't know what our house is worth next year. Say nothing about 10, 15 years down the road. And we've had a wonderful run of houses going up in value. We don't know if that's always going to be the case. 2008, it wasn't. So that's a guarantee that you never have to worry about being upside down. If that rule wasn't in place, I would not be involved with reverse mortgages. That is very significant, and it's guaranteed by the government insurance program.
That's incredible. Yeah, I'm so big in using the best of the best. So I really feel like you guys are the best of the best in this space. You know, me focusing on just life insurance and annuities, that's what I'm licensed to do. And I try to be the best I can be at that. And then, we bring in the wealth management when clients have those investment and planning needs. So we try to put everybody together to look at this to see where can we manage risk, and how can we make sure that we're doing the right things. And so I think that's so crucial to be able to try to, strategize and seek out the best in each profession, and then put those safeguards in place.
You don't know how important that is, Daniel. I was working with, we were talking to an advisor that wanted to work with us just 2 weeks ago. And I said, so tell me about your business. What do you do? And he said, I do primarily stocks, bonds, mutual funds. And I said, what do you do have you ever done annuities, cash value life insurance? Oh man, I sure hope I don't have to do any of those. I did have to do one like 3 years ago. And it was like, that was the end of our conversation. If we've got a guy that specializes in retirement and he doesn't know anything about cash value life insurance and annuities, that's scary. And so we don't work with people like that because there's going to be a problem in the end. And so what you're doing is way more important than sometimes your clients even realize.
Well, thank you. We feel like it's really important work, and that's why we're here to help serve people. We take time to do stuff like this so we can raise awareness and provide a lot of value and education to people who might be hearing little, 5-second sound bites about how a reverse mortgage is a ripoff, and then they make up their mind and they internalize that as like a truth instead of actually like taking time. And hopefully people will watch this and it'll kind of enlighten them as to like other options that are available to help improve their lives. So when would somebody be like an ideal candidate for one of these? Like, what are the criteria?
Well, what's interesting is in some states, including Arizona, you can go down to 55 and 60 in some of the products. But as soon as somebody gets to 62, for sure, they should be serious about looking into a reverse mortgage at that stage, not waiting. Somebody just said, well, why don't I just wait until I'm older? I don't need it right now.
Mhm.
We don't know when we're going to need it. And I asked that same individual, one thing you have to be aware of is that the best time to borrow money is when you don't need it. And a lot of people don't realize that you put it into place right away so that you're completely aware of all of the availability of that cash if and when you need it. And if you never need it, that's okay, because then you just had a charmed life and everything turned out really well. The other factor is that you are in the house that you're probably going to be in, not for the rest of your life, but at least the next 3 to 5 years. If somebody's moving in a short time, like a couple of years, they're just waiting for their granddaughter to graduate from college and then they're going to move or whatever, those people should not do a reverse mortgage. But for most other people, and this is where it's a shock for a lot of people, most people would be better off when we run the numbers in the software and we do the math, as we talked about earlier. Most of the time, you are best off doing a reverse mortgage as soon as you turn 62 if you're going to be in your house for at least 3 to 5 years. And that's an ideal candidate. You say, well, what about if the kids want the house? What about if it's a single person? What about if you have $10 million in investments or whatever? It doesn't matter. There might be tax savings for the wealthy person, might be income increase for the person who is struggling a little bit. In all situations, it makes sense to look at it as soon as you turn 62, just like Social Security. You look at that from 62 to 70. Medicare, you sign up for it at 65. You should do the same thing when you're looking at what you should do with your house equity, which could be part of perhaps one of the biggest assets that you have.
I love talking to you so much because so many more questions that come up that I'm excited to cover. And I know we have a limited time together, but being somebody who's a holistic planner and who looks for holistic planners like yourself, it really brings up so many incredible things. Like, I think a lot of people think of reverse mortgages as like a last like Hail Mary if you didn't have like a retirement plan. But you touched on some things that I really want to get to in a moment about some strategies that wealthy people should be using. And the math suggests that people are just better off accessing that equity and improving their cash flow with that than not. So I think that that's very fascinating, and I want to get to that in a second. But before we do, I just want to ask a couple of questions that I get asked all the time by people who are looking for these. So what is the cost of doing a reverse mortgage, maybe in comparison to, maybe another type of refinance or like a forward product?
Yeah, so a lot of people think they're very expensive, and nothing is really expensive. I mean, like you could say cars are expensive. I remember my dad buying a brand new Chev Impala when I was in high school for $4,000, brand new car. And now the average new car is over $40,000, 10 times what it was when I was a kid.
Yeah.
But do we still buy cars? Yeah, they're expensive, but it's better than riding a bike, and Uber gets expensive if I didn't have a car and I had to use Uber all the time. So what's the difference between that and a forward mortgage? There's only one difference. 2% of the value of your house you have to give up in the form of mortgage insurance of your equity. So if you've got a $500,000 house, you have to give up $10,000 worth of equity, not cash, but of equity. So if you're eligible for a $200,000 loan, you only get 190 because we carve out $10,000 to give to the federal government mortgage insurance program. So you never have to make a payment. You'll never be upside down. Your wife will never be kicked out of the house, et cetera, et cetera.
Yeah.
So that's a wonder. I think that's super cheap when you think about it. It's just a guarantee. And, I just sold my house that we lived in, that we brought up our four sons in. And I added up, we averaged, a few $1,000s a year on homeowners insurance. Do you know that we spent over $50,000 in those 29 years buying homeowners insurance, and we never had a fire. And no tornado ever came along and wiped out the house. And so I'm not mad about that. It was good insurance that I didn't have to worry about whether or not our house would be destroyed and we could get a replacement. So that's really the way that people need to look at this is, yes, you have to give up 2%. Why? To guarantee that you never have to make a payment, even if you go to 150, or if your house is upside down at the end, the kids are not responsible. So all other costs are the same. Appraisal costs the same, title costs the same, everything else is the same. It's just that extra cost of the mortgage insurance premium.
I look at the cost as the missed out opportunity cost if you don't do it. There's so many other benefits. And I know from after spending time with you and seeing it, like when I'm 62, that is absolutely the mortgage product I will own is a type of reverse mortgage, which I'm kind of enamored by, is this idea of the HECM, this product. So could you just kind of briefly, I know I didn't cover this with you before the video, but could you kind of just share with me a little bit about what the difference is between the HECM and maybe like a reverse mortgage?
Yeah, so a HECM is a reverse mortgage, but not all reverse mortgages are HECMs. A HECM, a home equity conversion mortgage, was started in 1988, which happened to be when our first son was born in October of 1988. So I always remember that. And that was started by the Federal Housing Administration by a housing act that year to help seniors age in place. That's the code word, age in place, that you can stay in your house as long as you want, and you can use the money in your house to help you enjoy the life in your house more. And so we also have situations that are not HECMs, but those are mainly for jumbo loans. Those are for loans that are mostly for houses in the 1.5 million up to 8 million. They have a higher interest rate, lower upfront costs. So they're not something that is wrong or bad. It just kind of depends on what the value of your house is. So that's the difference in the two products. Both products will get you the same thing. And that is what's already been written about with people in your industry that's done a tremendous amount of research, people that I've been fortunate to work with, because Wade Pfau happens to be a retirement researcher, a professor, and he went through it and confirmed that when you do either type of mortgage, your cash flow goes up because, of course, you don't have a payment anymore. Your income taxes typically go down, and your net worth goes up along with your legacy to your kids, either while you're alive or after you're gone. Wow. And so when you can get a product where, I mean, who doesn't want that? Your cash flow is more, your income taxes are down, and your net worth and your spending is up. Yeah. Because sometimes I'll ask people, would you like your cash flow to be a little bit more? Would you like to spend less in income taxes? And would you like to have a higher net worth and give a little bit more away to your kids or grandkids? And everybody says yes. And I said, well, then you've got to get a reverse mortgage. Well, we don't want one of those. Well, if you want to go to heaven, you have to die. I mean, that's just a prerequisite. And so that's even though a reverse mortgage may seem unpleasant or expensive or whatever, if you can accomplish those three things, just jump into it like that.
That's amazing. Yeah. I mean, that's really it right there. That's the benefits of having all three of those, which is so important for people. And that's what's stopping people, that barrier from helping people enter. So this is perfect time for this question, because I want to ask you, what are the other areas in retirement that this can improve that we might not think of that's associated with this strategy?
Well, it's obvious. It's very obvious that if you do a reverse mortgage, you can increase your income. You can pull money out that's been sitting in there for years that you've amassed over a 40-year career of working or whatever. Yeah. Or you can use it like I did to eliminate a payment, because I purposely did not pay off my house because I knew when I got to 62 that I was going to do a reverse mortgage. So I put less money when I was in my 40s and 50s. I put less money into my house so I could put more money into my life insurance and annuities. which turned out very well for me. And that's because I ran the numbers, the math, back when I was in my 40s. So if you don't try to pay off your house, then obviously you're going to have more money in other places. I've never seen a tombstone that says I died with X amount of dollars in home equity. But yet a lot of people live their life like that's the goal.
Right.
Well, that should not be the goal, because it's not, you don't win the game if you die with the most equity. Monopoly maybe, but not in real life. And so the issue is that when I'm going into that, my retirement phase, the less money that I put in that bucket 3 in my house, the more money I have in bucket 2. And it's, for a farm kid from Wisconsin who never went to college, that's as basic as I can get it. It's that I didn't put as much money into my house. I had more money in other places. I can do more things with my kids and my grandkids. So what we need to realize is that the cash flow is obvious. That's something that either you're going to eliminate your payment or you're going to get cash out on a monthly basis or a lump sum basis, however you do it. But here's the thing that a lot of people don't understand, especially people that are wealthy. People that have big IRAs, 401ks, where they have a bunch of taxes. Ed Slott is a absolute, he's on public television and everything else on IRAs. And I've worked directly with Ed Slott. He's done some of the research on this. And what he highly recommends is that you do a Roth conversion, take the money out of your IRA, taxes are due, which, yes, it's a pain to take taxes, but you'd rather pay taxes now than when your IRA gets bigger, your 401k gets bigger down the road, and pay for the taxes with your reverse mortgage. When you do that, you will end up with less equity, but more cash. And that's really how your net worth goes up. Again, wow. The cash flow, the taxes, and the net worth all working together. So that's one of the first things. Anybody that's sitting on a Roth IRA, because I've asked thousands of people in big groups and in small groups, do you think taxes will be higher or lower in the future? No one thinks they're going to be lower. Yeah. And so the issue is right now is the time to pay taxes. As unfun as it is to pay taxes, do it now, because if you don't do it now, it's going to be worse later. And people procrastinate, and then start paying taxes when they have a much bigger chunk and when taxes would be higher. But here's the other thing that's really exciting. And I'm going to share, I'll be real personal with it, because I have my own reverse mortgage, and I obviously, eat my own cooking from that perspective, because it makes a lot of sense. Now, when I did my own reverse mortgage, I planned from the beginning to not pay my house off, as I mentioned. There's about 44% of you listening to this recording who are over 62 who are still making a mortgage payment. And I was one of those 44%. So my interest rate and the interest that I'm paying, my amortization schedule looks like this. I started out with a $480,000 loan balance. It goes to, I don't make any payment. So it goes to 498, 518, 539, and so on. It keeps going up. Negative amortization, which scares a lot of people. Oh man, it keeps getting to be a bigger bill. That's okay, because the value of my house over here is also going up. So I don't care if my loan balance goes up. And if my house doesn't go up in value, that's okay, because I still never had to write a check. Now, if you take a look here, about every 3 years, I'll have at least $60,000 worth of interest accrued. That's when I'll pull money out of an IRA, which I don't have a lot of left because I've already done a lot of Roth conversions, but I'll pull money out of any taxable income and I'll pay it. Step one, I pull that money out. Now I get a 1099, so I owe money. But then I do a 1098 because I'm going to pay that money into my reverse mortgage, because I owe $60,000 worth of interest that I don't have to pay. The payments are optional. So I want to make that payment. So I pay that down. Here's that $540,000. I'll run my balance right back to $480,000. When I do that, I'll be able to deduct $60,000 plus any other deductions that I have. So every 3 years, I'll be able to deduct about $90,000. That means that I will have pulled out $90,000 out of my IRA tax-free every 3 years. I can do that 7 times between now and when I'm 80-some years old. That will be $250,000 in taxes. I really don't care about my closing costs being $29,000 on this loan. So that's the scenario that's really cool. And oh, it gets better. This is like the Ginzo knife commercial. And one more thing.
Yeah.
We got free shipping and handling. No, it's not free closing costs. But once I pay that in, I can pull it back out tax-free and reborrow the money. It's just really awesome. So I'm going to do that. And I'm just, like I said, a farm kid from Wisconsin who never went to college. If I can figure that out, why can't everybody figure this out? It's not that complicated. It's just kind of cool. And if you want to pay more taxes because you feel sorry for the government needing money because they're really in debt, well, then don't do this. But if you want to pay less taxes, this is a great way to do it.
Thank you so much for pulling up your own amortization table and showing. This is something that Harlan explained to me in Denver as we were like both walking out the door trying to catch a plane. And I was like, wait, hang on. You got to go through that with me one more time. So I'm so glad I got to see it. What an incredible strat. I mean, that should be a topic just in itself. I mean, that's really cutting edge, incredible things. And I'm so grateful to be able to share this with people because of you, Harlan. So thank you so much for joining me and sharing that with me. It's just been an absolute honor to be a part of this time with you.
Well, thank you. And in my next book, I've got a chapter on that specifically, but I already wrote the chapter. And so if any of your clients want to read it, I talked to a tax attorney about this. So I know it's something that is safe to tell people about, and I'd be happy to share that.
That is incredible. Harlan, when does that book come out?
Well, my wife keeps asking me that. She took me on a vacation last time and locked me up for a week. So we're intending it to be 2023. So I'm sure she'll make sure that she kicks me out.
My wife has strict instructions that if I tell her I'm writing another book, she's supposed to punch me in the face first to make sure I'm serious about going through that process. But anyway, Harlan, where do people get access to this information? Like, where do they get more of you? Where do they get more access to this? What can we put in our description down here that people can get more information on this?
Well, I'll just share my signature page here, which is got the contact information. And I don't personally do any reverse mortgages myself anymore because I do all the training. But we have several hundred loan officers around the country. And if you just call my mobile or the office number or my email there, I'll make sure that I direct you to somebody in your area that will work directly with you wherever you're located. But obviously, if you're working with Daniel, start there because we like to already have a financial plan because Daniel's the quarterback. We just come in and we go wherever Daniel tells us to go based on the overall plan. So start with him. But if you have any questions and you want to reach out to me specifically, that's the information right there on the screen.
That's incredible. We'll get that in the link to this description. If you really like this video and you got something special out of it, please like this video and share it with people. Consider subscribing to our channel. We're going to be coming out with all kinds of content like this. If you want access to Harlan, his team, to get more information about anything you heard in this video, check out the description below. We'll have all of their info from Fairway and specifically Harlan. Thanks for sharing your personal information. We appreciate that. Thanks so much for joining us. We'll see you in the next video.